Hi guys, my name is Samrid Rela and I'm starting off this YouTube channel to talk about stocks and personal finance in general. So without further ado, in this video I'll be talking about a micro cap company that goes by the name Premier Roadlines. So the topics that I'll be covering in this video are its business model, different verticals the company operates in, the risks pertaining to the business, financials, management guidance, and lastly valuations. So let's just talk about the business model first. So Premier Roadlines basically is a B2B logistics company that transports goods, right? So one interesting thing about the company is that the company does not own any of its fleet. Rather, it outsources it to small fleet owners, and the company has its own ERP and ERP software as well as its GPS tracking that helps them in tracking across the country. So let me just give you an example. Let's just say uh, there's a customer that asks Premier Roadlines to transport goods from Jaipur to Delhi and is willing to pay rupees 1 lakh for that. So Premier Roadlines, out of that 1 lakh, will pay 87,000 to the small fleet owners, from which they take the trucks initially, and the rest 13,000 goes into the pockets of Premier Roadlines. So that is the business model in simple, right? So basically, if you look at it, it's like a technology company operating in logistics industry. Now, coming to the industries that the company caters to, there are industries like infrastructure, energy, power, construction. Now, talking about the different verticals that the company works in, right? So, number one is project transportation, right? So, what happens in this is that the company bids and wins a contract to handle an entire project. So, in FY23, the company made 38% of its revenue from this vertical. The second vertical is over dimensional or over cargo weight. So out of this vertical, the company made 21% of in FY23 in its top line. So in this vertical, basically, it is self-explanatory. So overweight cargo, basically has goods that exceed a vehicle's dimensions. So they require added safety and security measures. uh, Third vertical is contracted integrated logistics services. So out of from this vertical, the company made 19% of its revenue in FY23, and so in this, basically, the company gets contracts from customers. And lastly, the fourth vertical is general logistics, from which the company made 22% of its revenue in FY23. Now, one important thing is that from the first two verticals, that are project transportation and overweight cargo, these are higher margin verticals. So the company made north of makes basically north of 12% margins in this. And the third and fourth verticals, which are contracted integrated logistics services and general logistics, the company makes around 10% of margins from these two verticals. So now coming and talking about the risks of the business. So number one risk is that the debtor as a percentage of asset has been really high. So what this means is that the company has been doing selling on the basis of credit, and they're not able to generate cash out of it. So if we see in the past 3 financial years, so the debtors as a percentage of asset in FY23 were 80%. In FY22, they were 84%, and in FY21, they were 79%. So they are extremely high. So this is a very major risk. Now, talking about the second risk pertaining to the business, that is not really specific to Premier Roadlines, but it is specific. It is concerned with all the SMEs that are listed. So all the SMEs have to post results on a half yearly basis. So usually all the other companies have to do it on a quarterly basis. So we as investors would not know what really happened from in Q1, right? We don't know what happened in April, May, June with the company, right? We only get to know it at the end of September, which is the end of H1. So Q1 and Q3 we have no clue. So it's just two biannual results that we get to know. So that is another concern with respect to any SME company that is listed. Now, talking about the financials of the company. So, in FY24, the company's top line was rupees 229 crores. That was up by 19% year on year. The operating profit was around 20 crores, which was up 64% year on year. And the PAT, which is the net income, was up 75% year on year to 12.6 crore rupees. Now, this clearly shows that operating leverage has been kicking in the business. Now, there have been expansions in the margin as well. So, there were basically two reasons because of which the margins expanded. Number one is that the company was focusing on higher margin project segments. The two segments that I told you about, project logistics and overweight cargo. And secondly, the company has recently implemented the ERP system as well. So since the company has been using technology, they have cut down on the costs. I went through their financials and I checked. So I saw in FY23 and FY24, their employee benefit expenses were same for both the years, right? I think they were around 9.6 crores. So these are the two reasons because of which there was a margin expansion. Now, talking about the IPO proceeds, so company raised somewhere around 15 crores in debt, which they have utilized and already repaid their debt. So now the debt to equity ratio has come down to zero point 0.9 in FY24 from 1.4 in FY23, and the company also utilized some money for the purpose of purchasing of vehicle for commercial purposes. So the company had borrowed basically 2.8 crores, from which they have taking the vehicles that they were supposed to. Why am I talking about the IPO proceeds? Because it's very critical. We as investors make sure that whatever the IPO proceeds that the company had taken, they have been utilizing that same money for the reasons that they had mentioned in their IPO prospectus. Now, talking about the guidance that the management has given. So, there were basically three, four things. Number one, company has been focusing on higher margin segments like project logistics and over-dimensional cargo. Number two, the company has said that for FY25, they have given a revenue guidance of 300 crores, which is basically a 30% jump from FY24 revenue, right? And the split between the FY25 revenue would be 35% in H1 and 65% in H2. So that basically brings us to an amount somewhere close to 105 crores in H1. And the reason behind this discrepancy is so in H1, there basically monsoon and there are elections, right? So because of these two reasons, the business gets hindered. And thirdly, the management has also told that the PAT margins would be somewhere between 5 to 7%. So if we take it, I'll just take a middle number. So let's just say that the PAT margins are 6% on a revenue of 300 crores. The PAT comes down to 18 crores. Lastly, I'll be talking about valuations. So the current PE, while I'm shooting the video, is 24, and the 1 year forward PE, which is calculated as the current market cap divided by 1 year forward earnings. So if you divide 300 divided by 18, which is the future earnings, the PE comes down to 17. So this looks like an interesting bet. Guys, that's it from this video. One disclaimer that I would like to give is, in case you feel like investing in this company, then you should do your own due diligence or consult your financial advisor. So that's it from this video, guys. I'll see you in the next one.